what becomes more difficult to people is thinking about things in 3 dimensions or multiple dimensions. And the reality is Vana and Charm are the contrary effects to Gamma. Gamma is the change in delta, right? As you approach or move away from of an option strike. As you get to strike, Gamma's at its highest. You can go from something being a 1 delta, right? As you move all the way to a 50 delta, 50% probability of it being in the money, and hedging that 50% demands a lot more delta, right? That thing, I think that Gamma itself, people can broadly understand. But what people have a harder time understanding is that as time passes, right, those deltas themselves also change. If something has a 30% delta right now of being in the money, and I have 10 days, but it's 2% out of the money, guess what? If I get to 1 day and it's still 2% of the money, the probability has dropped dramatically. It might only be 1%, right? That is the change in time of delta, and that's what we call charm. Charm itself is very powerful as you start to approach expiration. As you might imagine, these things really start to fall off quickly. The cousin of charm is what we call Vana. Vana is a function of implied vol. There's a natural upward sloping of the volatility, implied volatility surface as you go out further in time, much like the yield curve historically, although right now the yield curve is inverted. You see a liquidity time premium till further out implied volatility historically. That means as the market, as things get to expiration, the implied volatility itself decreases. And because of also the structural support that we see during these periods, we tend to see volatility compression in these periods as well. As implied volatility comes down, those deltas also come down. So there's a risk of a very high volatile situation, as you might expect, something 2% of the money, maybe a very high probability, maybe 40% probability if we're 10 days out, like I said, and there's incredible volatility. But if implied volatility comes down, if the expectations of vol drop to, hey, the market's pinned, we're not going anywhere, something 2% of the money might be a very low probability. And that as implied volatility comes down, the pricing of options, the expectations of volatility come down, deltas themselves decrease for out of the money options. That is what Vana is. Vana and Charm are the changes in delta of the people, of the dealers warehousing the risk. And those are the factors that drive flows based on time, based on changes in implied volatility. And actually, the majority of circumstances, particularly for the indexes, right, are the most important factors and the things that you can really model to understand outcomes for the market based on time and price.